everybody to this Hardman Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's or a fund's investment case and question the management. Speaker today is Hardman's own Nigel Hawkins. Nigel's an analyst specialising in the energy, utilities, infrastructure and renewables sectors. He's been involved in analysing the utilities sector since the 1980s, when he was part of the team that privatised the electricity and the water companies between 89 and 95. He writes for the Utility Week magazine. He's also got quite a political background, which is important in this sector because a lot of what drives share prices is regulation. Between 1984 and 87, he was Margaret Thatcher's political correspondence secretary. He joined Hardman in February 2016, and he's going to give a presentation on the renewable sector. Nigel, over to you.
Thank you very much, Keith, and thank you very much to MJ Howard, who are hosting us here this afternoon. The key events in the sector over the last few years have been first the privatisation of the electricity supply industry in 1990 and 91. And in the intervening 30 years, we've seen some major structural changes. You'll have seen also the events in Glasgow over the last couple of weeks at COP26 and the efforts to get rid of coal as a fuel. The rise and fall of gas is also particularly topical at present. In the 1990s, early 2000s, it was very much base load. It has now moved in many cases to mid-merit. And nuclear's picture is very mixed. The fleet, except Sizewell B, is getting very old, whilst Hinkley Point C is being built at tremendous expense. It won't be producing electricity for many years. And we've also seen recently is the advent of renewable generation, particularly over the last 3 or 4 years. It really has increased in terms of capacity and generated output. There are 7 major technologies, excluding nuclear. They are wind, hydro, solar, biomass, marine, geothermal, and fuel cells. But for the UK, onshore wind is key, and it's also true that solar power is really progressing in the south of England. And I think it's fair to point out that most UK renewables generation is either from the integrated players, established players such as SSE and Vattenfall from Sweden, or from the renewable energy infrastructure funds. The next slide shows classifications. We use the AIC, Association of Investment Companies classification, to look at the 21, what we call REIFs, Renewable Energy Infrastructure Funds. There are quite a number of comparisons with the infrastructure investment companies, IICs. HICL, 3i and BBGI are probably the most well-known, all have capitalizations over £1 billion. But the smaller renewable energy infrastructure grouping, 21 companies, including Harmony Energy, that was quoted very recently for the first time, and Pantheon Infrastructure, whose quotation started just last Tuesday. The sector for the REIFs, 21 of them now, is worth over £14 billion. And the focus really is onshore wind. That drives the numbers. There are also 3 quoted solar REIFs, and increasingly, particularly over the last year or so, battery storage development has become of great interest to investors. Looking forward, offshore wind will certainly be very important indeed, particularly for Germany, you have to say, with the Baltic area being very attractive, and the fact that Germany will be closing down all its nuclear power stations fairly shortly. So offshore wind will see a very large investment. As for the 21 REIFs in the UK, most operate in the UK, wind plants and so forth. Many are expanding into the European Union, and some have US operations. Indeed, some are actually US based. The 2 leading funds in the 21 strong sector are TRIG, the renewable energy company. That has a market capitalization of about £3 billion, and In addition to that, there is Greencoat UK Wind, which has the second highest market capitalisation, £2.6 billion. What's in it for investors? Well, first of all, a strong defensive play. And during COVID-19, as we know, certain sectors were hammered, but not renewable energy infrastructure funds. Yes, in some cases, but indeed in most cases, there was a chasm in terms of share price in March 2020, but all have virtually recovered their losses, with a few exceptions admittedly. Investors also benefit from relatively predictable output levels, although it is true autumn 2021 there has been a lack of wind, which will, I suspect, appear in some companies' numbers over the next few months. It's also the case that there are substantial government subsidies, especially for solar investment. And we've seen since January 2020 a very encouraging fundraising record with close to £5 billion being raised over the last 22 months. For investors too, they will be comforted by impressive ESG credentials, and the companies are pretty upfront in publishing what they do in terms of ESG. I mentioned earlier the very resolute COVID-19 experience, and obviously contrast with the hammered aviation sector, hotel, hospitality, and so forth. Current prospective yields are around 5%, and for the bigger players, slightly higher than that. And the impressive total shareholder returns warrant mentioning. I put down on this slide TRIG, total shareholder return at 9.3% per annum since August 2013. That's, I would suggest, quite an impressive figure. Greencoat UK Wind, also on ESG, is very forward. If you look at their results presentation, you can see they list it very clearly what they're doing in each of the three branches of ESG. But like any investment, there are risks. Phasing out of subsidies is obviously a risk. And indeed, new solar plants no longer get subsidies post-2017, which has meant there's been a bit of a hiatus in solar investment. Low wind levels, as we've seen very recently, is a concern. Low power prices. Now that probably will change, but certainly a year or so ago, year and a half or so ago, some of the funds had big hits because the net asset value is calculated over longer term power price projections going up to, shall we say, 15 years. And TRIG in particular had a hit to its net asset value of over £100 million. Dividend growth is also obviously a key issue. It may be curbed. In some cases, dividend has been held. And I think it's worth differentiating between nominal dividend increases, which we've seen with many of the funds, and indeed most of them, and real dividend increases, which will be much harder to achieve given rising UK inflation. And it is the case that dividend cover for some funds is actually quite thin. I've quoted here Next Energy Solar being one that's thin, and also JLEN, the old John Lang Environmental Fund, that also is a bit thin. Adverse tax changes are always a concern. But I would say that the defensive element also does limit share price growth. Comparisons to Centrica perhaps may not be too direct, but Centrica's share price has gone down roughly 2/3 over the last 5 years. And if Centrica had a really good run in terms of investor sentiment, clearly the share price increase would be considerably higher, I would imagine, than virtually any of the 21 REIFs. I mentioned the fundraising had been quite impressive recently. 21 REIFs securing £5 billion of new investments since January 2020. It is a very reassuring fundraising record. And in virtually every case, the money raised has been at a very low discount to the prevailing stock market quotation. Now, I accept that Capita may sound a bizarre comparison, given it's in the IT market rather than involved in energy. It is perhaps relevant to point out that Capita needed a 56% discount for its underwritten share fundraise back in 2018. And that's a very big discount, obviously, compared with the discounts we're seeing for the REIFs. It's also fair to say, perhaps, that Capita's share price has actually fallen subsequent to that massive fundraising effort. We'll see a bit more from Greencoat UK Wind. They've got an equity issue going on at present. And when we've got full details of fundraising, but I'd be surprised if they had major problems in raising the money they want. And another very encouraging sign is Pantheon's infrastructure. Dealing started last Tuesday. They tried to raise £300 million. Their maximum they could raise was 400 million. And even on 400 million, they had to cut back some applications, so they didn't go over their ceiling. However, it's not all perfect. Some REIFs have had to settle for lower proceeds than planned. And if you look at some of the prospectus figures, aspirations for fundraising and what they actually raised some weeks later, there's a significant difference in certain cases. And we've actually had some outright failures, Blackfinch, for whatever reason, being one. The next two slides show the REC fundraising over the last 22 months, both in terms of new shares, the price, and the actual gross proceeds. But it's clearly a sector where fundraising, as the government tries to drive out new renewable investment, has been very successful, although almost by definition, some of the attempted fundraisers get less publicity than those actually that actually are successful. So those two slides just list what's happened over the last 22 months. In terms of conclusion, I think message number one, renewable power has certainly come of age over the last 4 to 5 years. It really has come of age, and we're talking about contributing in terms of output, something like 30% of UK generation. And I would suggest that the REIF sector of the 21 funds is certainly worth assessment by discerning investors, particularly those looking for solid dividends. I accept the sector compared, shall we say, with a National Grid or a Centrica with quite low profile, but certainly the returns and so forth are attracting interest from potential investors. The defensive characteristics I have mentioned, given that a lot of it's dealt with on contracts, long-term contracts and so forth. And whilst achieving substantial real dividend growth will be tricky, the quest for secure nominal dividends is still out there. And obviously people will make a lot of comparisons with the yield on 10-year gilts. I'm fairly certain that more IPOs will follow. After the last couple of weeks, we've had both Harman Energy and Pantheon Infrastructure appearing. And I think also, whilst most of the focus will be on wind power, onshore, particularly in Scotland, and offshore, particularly in the Atlantic and in the Baltic, there's also increasing interest on battery storage. And it is significant that we have had one or two new funds really focusing on battery storage. There's a recognition that the reserve levels are so low that anybody who can devise schemes and systems to store renewable energy is onto a very, very good thing. It'll take time, but that is one of the areas really being chased by those battery storage funds. Having said that, I would now like to hand back to Richard, and I'm happy to take any questions if there are any.
Nigel, there are a number of questions. I'm going to start with a specific question from Paul. So this is to clarify something we talked about earlier. What is the extent to which the income flow of each of the quoted renewable energy investment funds is index linked?
Well, the first thing I should say is that dividend cover recently has got quite low for certain companies. But inflation generally is good for the companies, and the larger ones actually do publish charts showing if inflation went up by 0.5%, how much that would actually benefit their net asset value. I would say also that irrespective of inflation, there are other very pertinent impacts on the returns and cash flow of individual funds, particularly power prices. And a particular example came to mind as of yesterday, when Scottish and Southern Energy confirmed that wind speeds in Scotland in the last few months have been quite weak. That's bound to impact upon Greencoat UK Wind, which, whilst it may have quite a good cash flow, I suspect for 2021 will be adversely impacted by the lower wind speeds of recent months.
Paul's got a follow-on. Is it true that JLEN has the lowest level of indexation and Greencoat UK Wind, UKW the highest?
I can't give a precise answer on that, I'm afraid, because it's very complicated to work it all out. There are, say, various drivers on the valuations, and indeed on the cash flow of the individual funds, some power price related, some inflation related. But I say they do all publish, at least the larger ones, publish inflation assumptions, which are actually different going right forward over a number of years. They do have differing inflation assumptions, which also makes it more complicated.
This is an interesting question. Nigel, you've been in the markets for many years. What indicator would there be for the investor that the current fundraising have reached an unsustainable level?
I think, as is perhaps not surprising, investors get more and more discerning as more applications come to raise funds. I think on battery storage, it will be a case of not just battery storage, but why do you think a particular fund can actually do something really good? And if you can prove that, then you may find it relatively straightforward to raise funds. But just a more general viewpoint, we think battery storage is the thing to raise money for because national grids having problems keeping the lights on. That type of thing, in my view, wouldn't be good enough. I think on wind, which after all is the biggest consumer investment, in England, it is increasingly difficult because of the planning and so forth to get wind, or to get approval for wind investment onshore. This may well be changing. I think in Scotland, it's rather easier. And then, of course, the bigger one will be the offshore wind, and the amount of money involved will be vast. You may have seen the white paper and the pledge to get offshore wind increasing by 3 to 4 times over a decade. That will require a very, very great deal of money. And I think it would be brave investors initially who go into offshore wind. There are certain problems involved with offshore wind. And of course, the amount of money involved will be considerably more than the standard onshore wind. So we may see a lot of consortia, and we may see various deals with getting the wind ashore, whether with National Grid, being closely involved. But you must remember, for offshore wind, the turbines involved are very, very much larger than onshore wind, and hence much more expensive. And indeed, I should add, they consume a very large chunk of the total investment.
Okay, so moving on to solar. Is UK solar viable without subsidies?
A very good question, and a question analysts do ask the 3 solar funds. It is true that 1 or 2 investments have been made post-2017 without subsidies. Nexen Solar in particular has invested in, I think the capacity is 50 megawatt plant. I think the jury's been out on that. It does depend, A, on what sort of contracts they can get going forward for the output, and particularly, of course, on what price. So it's something we'll be looking at fairly carefully over the next 3 to 4 years. But it's fair to say that the level of solar investment since 2017, if you look at charts on that, is significantly lower than pre-2017, irrespective of COVID.
You touched very briefly on hydrogen, but there's a lot of people think that this could be a very big sector. What are your thoughts? I mean, we could look at this in the context of electric vehicles, for example.
I think it's a bit like battery storage. I think many major investors will say they want more details of precisely what is being planned by a particular fundraise. Is it putting hydrogen through existing gas pipes, for example? I think I'm right in saying some trial has taken place in Leeds to do that. Is it successful or not? There are various types of hydrogen, there are various possible uses and so forth. And I think it's something where you would need a real niche area saying we are going to deploy hydrogen to do A and B. And B, I think particularly with many renewable IPO presentations, many discerning investors want someone presenting who has got real technical knowledge about the particular area, whether it's hydrogen, whether it's battery storage, before they commit funds. And I think increasingly that will be the case.
Okay, I've got a question from Charles. It's a very specific question. It relates to the Rolls-Royce mini nuclear power plant project. Do you have any comments?
Yes, very interesting. It's not totally new. Rolls-Royce has been talking about this for many years. It's fair to say that the government has been appalled at the situation at Hinkley Point. 23 billion is the latest figure, probably going northwards, and timing is probably going to go further out as well. And the concern, particularly if Chinese investment is not allowed for future ones post Hinkley Point C, such as Sizewell and others, I think increasingly they will be looking at small reactors. What you have to remember, though, is reactors take a very, very long time to go through the approval process. It's extremely complex. And I always use the argument, if you were a senior civil servant approving plants like that, you have one word in your ears: Chernobyl. And real concerns that are any of these plants which are being submitted, are you absolutely certain that they're safe? And I think that's bound to cause delays and so forth. With regard to Rolls-Royce itself, it's not really a company I follow. I suspect some would say perhaps Rolls-Royce should really focus on the very difficult engine market rather than getting too involved in nuclear. But it may well be that they've got ways of getting around that. And it may well be they say, look, the amount of investment we're going to do is actually quite small. What we'll do is use our technical knowledge through our involvement in nuclear submarine technology to get that going without necessarily spending a vast amount of money from the Rolls-Royce account on it.
Okay, I think we've just finished with a more general question. What are the most favoured overseas markets for renewable energy funds?
Well, initially it was the UK wind and so forth. That was the market. And the two big ones, Trig and Greencoat UK Wind, did very different things. Greencoat UK Wind says we stay in the UK and we only do wind. Trig says, well, we're going overseas. We're going to Europe, particularly Northern Europe, where wind is attractive. And we're doing a few things outside wind. So there's a big difference between the big two there and what they actually do. What we've seen recently is a number of funds launch which are cherry picking some of the best opportunities across Europe. And for example, Octopus is one, Octopus Renewables is doing that. And we've seen Aquila as another one. So cherry picking some of those areas, which tend to be wind in Scandinavia and solar in Southern Europe. That tends to be the focus. There are one or two American ones, perhaps rather different criteria apply, like US solar. But the bottom line is that we are seeing more and more of a pan-European approach, I think, rather than the basic Greencoat UK approach, which is we only know the UK, we only deal with wind, and judge us on that.
Nigel, thank you very much. It's been delightful chatting to you. I'm now going to hand back to Keith. Thank you.
Thank you, Nigel. So that concludes the presentations today. I'd like to thank our speakers and you, the audience, for attending this forum. Thank you very much.